Good morning, good afternoon. Thanks to everyone who's joined us already. We're giving it a few more seconds for people to join, and then we'll get started. We've got lots of people on already, so I think in the interest of time, we can get started now. So first off, good morning, good afternoon, everyone. Thank you for joining us for this webinar organized in partnership with Innovate Finance and Hogan Lovells. By way of introduction, or maybe reintroduction for some of you, my name is Matthew Serviat, and I'm the US lead for Innovate Finance, the independent industry body for fintech companies in the UK. Together with Hogan Lovells, we had welcomed some of you to a pre-US election session last September that focused on the forces at play and the potential impact on fintech and transatlantic relations ahead of the US election. A lot has changed since then, and today we'll be discussing the regulatory and enforcement shifts that followed the 2024 US elections. We are very excited to welcome back Sharon Lewis, Hogan Lovells partner, financial institution sector head, and co-chair of the digital asset and blockchain practice. Sharon will lead a conversation with Sarah Lennett, Carl Racine, and Jason Downs, who are Hogan Lovells partners based in Washington, DC, and Rita Hunter, who is a partner based in London alongside Sharon. The webinar will last for 1 hour and will be recorded. We will explore post-election impacts on fintechs and financial institutions, from digital assets to ESG, and we'll also discuss what all of these US changes might mean for the UK. Speakers will be presenting their views first, and there will be a few minutes at the end for Q&A. You can also share questions via the chat. Now, without further ado, I'd like to thank you again all for joining us, and we'll leave you in the expert hands of Sharon Lewis. Sharon, over to you.
Thank you, Matthew. What a welcome. Thank you, everybody, for participating, particularly my co-panelists. What a time. I think we've lived the last 4 months, it feels like several years of big change in the fintech industry, big change in some of the areas which are important to the fintech industry, particularly ESG, and big change, huge change in the digital assets industry. So often when I think about this, I try to think about, when we have big change, there's challenge, but there are opportunities. And so this webinar is going to really focus not just on the challenges, but on the opportunities. And I really, really hope that you will see that coming through. And so with no more ado, I'm going to hand over to Sarah Lennett. In the first instance, she's going to talk about the regulatory landscape and the opportunities for the fintechs. And then we will go on to ESG and digital assets. So over to you, Sarah.
Thank you, Sharon. Hi, everyone. I am going to take a few minutes to walk through some of the regulatory changes we've seen in the financial institution space here in the US over the last few months, as well as opportunities that creates for fintechs operating in the US, whether based here or not. So to start with a little bit of table setting, I want to say that in the US, a lot of the practical implications for regulation of banks and other financial institutions happens at the regulator level. So, while we have Congress adopting statutes and making law, regulations are adopted by the regulators themselves, and then implementation, where it comes from supervision, examination, enforcement activity, is at the regulator level. So as administration changes and leadership changes at those federal bank regulators happen, we see a lot of practical changes, both in the banking space and then trickling down to others in the financial institution space that deal with banks indirectly or directly. So, as you all know, a lot of FinTechs in the US, to the extent they're non-banks and operated, are regulated at the state level. So there's a lot of questions about, what's happening in the states. But there are a lot of opportunities created by what's happening at the federal level too, and with banks. So I wanted to highlight some of those. The new leadership in the federal bank regulators have all put out statements about what they see as priorities for the federal bank regulators, and they have similar themes. So those themes I can break down in about 4 ways. It's reducing regulatory burden. So that doesn't necessarily mean less resolution, but they highlight increased transparency and tailoring regulation to particular institutions. So we'll get to what that means and opportunities that creates. Promoting financial inclusion, as well as an increased focus on what was perceived as debanking by the regulators under the prior administration. Embracing bank fintech partnerships. I'd really like to zoom in on that one, and I will in a minute. And then expanding responsible bank activities with respect to digital assets. So I'll touch on that a little, but then Jason will have a lot to say on that as well. But zooming in on embracing bank fintech partnerships. So I think many of you listening are probably very familiar with the landscape in that area over the last few years. Under the prior administration, there was a lot of focus on that. There was guidance put out for US banks about how to safely engage in relationships with fintechs as that was increasing. A lot of you, if negotiating with US banks, were probably very familiar with the third-party guidance that the federal bank regulators put out and all the requirements they expected to see in relationships between banks and fintechs from a risk management perspective. And all of that is still in place, and regulatory and supervisory expectations are still high. But what the regulators are saying now is they really want to promote this more. There was a lot of enforcement activity in that space over the last few years. So banks were, even if not subject to publicized formal enforcement actions, behind the scenes, they were subject to a lot of informal enforcement actions, which had the effect of drying up that market and lessening the ability of banks to engage with fintechs. So that may be something that directly or indirectly impacted a lot of fintechs around the world that were seeking to do business in the US, because it was difficult at times to get a banking relationship either as a service provider or just as an account provider. So I wanted to zoom in on that to say that embracing these partnerships and innovation is something that the bank regulators have highlighted as an area of focus under this administration. So there is an expectation that there will be fewer enforcement actions, more encouragement of this, and I think we'll see that market opening up. What does that mean for those on the fintech side? Well, it means, it will be easier to find banks in the US to work with, whether you are looking for bank partners for a banking as a service type arrangement, whether you're looking for, bank accounts, especially if you're a fintech that engages anything or having to do with crypto or digital assets. I'm sure that has been difficult over the last couple years, and barriers to that should be lowering. And one of the main advantages to the non-banks and the fintechs of working with a bank in the US, for market entry or other purposes is the banks have the existing infrastructure and regulatory authority to provide whether it's payments, whether it's other types of money transmission, whether it's lending, without the 50 state licensing regime. So without a bank partnership, as you may know, if you're going to service US customers, you need to think about state by state licensing. And that's one of the advantages of the bank partnership model. Another increased, opportunity in the US that we foresee in the next, months and years is for de novo chartering. So for any fintech that is interested in actually obtaining a de novo bank charter, or even acquiring an existing US bank and operating as a bank in the US, that's something that it is never easy to do, and there are a lot of regulatory expectations on that. But we see an increased appetite for those types of novel and unique applications to be approved. So I then want to I touched on this a little bit before I hand it over to my colleagues on digital assets as it relates to banks. So as you all may know, or those in the digital asset space, under the prior administration, each of the federal bank regulators had guidance that they put out that said to the banks that they supervise that they cannot engage in any digital assets or crypto related activities unless they come and discuss it first with the bank regulators. And the reasons behind that were based in safety and soundness and prudential risk management. And the bank regulators wanted to have a sense of exactly what type of activities a given bank was going to engage in before doing it, and make sure that they had an opportunity to address any associated risk management implications. Well, as you know, the Trump administration has been running on a pro-crypto, pro-digital asset agenda. And as such, over the last few months, each of the federal banking regulators has withdrawn that guidance. So what that means is that banks are no longer strictly required to go to their regulators and seek non-objection before engaging in digital assets or crypto-related activities. How that plays out and what that means is still to be determined, but anecdotally and in talking with industry groups, we know that under the previous guidance, there were very few banks that were getting a sort of a green light to proceed. So there was a perceived freezing, at least in the US, on US banks engaging with digital assets or digital assets related customers over the last few years. And now what the bank regulators are saying is you don't need to come and ask for our non-objection. You need to, consider risk management and your risk profile and your, BSA, AML procedures, just like with any new activity, but there's nothing necessarily uniquely risky about digital assets or crypto. So the messaging is quite different. And in fact, the bank regulators are saying that in some ways, over the last few years, crypto firms have been, quote unquote, debanked, where it was really hard for them to engage with the US banking system. And there's a focus on making sure that crypto firms and others are no longer, debanked from the US. So again, opportunity for innovation, for fintechs that have, any relation to digital assets. There should no longer be the same type of barrier to seeking bank partners or bank accounts. And so I think there's a lot to think about, whether that's a business model currently or in the future for fintechs, and reducing that barrier if you're thinking about operating in the US or US entry is really important. So I'm going to stop there and hand it over to Carl then to talk about ESG.
Thank you, Sarah. And over to you, Carl.
Thank you very much, Sarah. Very much appreciate your discussion there. Before I get to ESG, and certainly not to put a damper on the opportunity that Sarah discussed, the opportunity is indeed tremendous in the federal sector. People do need to keep an eye out, however, for state attorneys general. in particular Democratic state attorneys general in the United States, they may not be entirely on board with the way in which the federal administration is opening itself up to business in fintech or crypto. States have a different mindset, and you have to be careful in particular of certain aggressive states like California and New York and others in every regard. Now let's get to ESG and the Trump administration. Well, as the slide pretty briefly tells you, ESG under the Trump administration is a really foul term, and the administration has made it clear that where financial services and other businesses are practicing ESG or woke, then the Trump administration is going to be quite aggressive in seeking to come after those businesses, in particular businesses in the financial sector and insurance sector. What that means on E is that investment in fossil fuels is in, drill baby drill. And what that means is that certain states that had very aggressive state laws that were all based on protecting the environment as far as those states saw it, states again like California, New York, Massachusetts, Maine, and Vermont, those states are now subject to executive orders that the Trump administration has recently rolled out, calling into question the state's ability to set a higher level of environmental protection beyond that which the federal government sets. And so there'll be some interesting legal developments there. The other thing we should know is that the federal government has very much divested from investment in sustainable energy, in particular around batteries and other EV type of programs related to vehicles. So when it comes to the environment, it's no longer a sustainable focus or a climate focus. That was the focus of the Biden administration. Now we're talking investment in traditional fossil fuels to include coal. Let's go ahead and go to the next slide if we could. When it comes to ESG and this administration, we've all seen it at different levels. Not only has the focus been on E and climate, but with increasing ferocity and aggression, the focus is on the S, social, with particular emphasis on DEI. DEI, of course, is diversity, equity, and inclusion. The federal government sees DEI as effectively being illegal. Now, I think most legal scholars would tell you that DEI is not in and of itself legal. It's a broad term that defines a lot, but I think it's important for us to be aware and mindful of how the Trump administration views that. And indeed, companies, both national, domestic, as well as global companies, are understanding that they're going to have to change the manner in which they describe their DEI efforts. What is absolutely unlawful and will certainly get the attention of the administration are targets or quotas related to the hiring of any particular group, be it racial, gender, or ethnic. That is why our firm and others are really focused on helping companies audit their DEI practices and make those kinds of changes that would be so flagrantly afoul of the Trump administration's priorities, so as to almost surely garner unnecessary attention. And that's what we're seeing from our clients. Our clients don't want the legal risk, don't want the reputational risk, and are moving away from some of the ways in which they've described their DEI efforts. I should note that there had been some effort from the Trump administration to export their view of DEI to globally based companies that are headquartered outside of the United States. Whether they have the legal ability to actually enforce some of those threats, I think the better view is that they do not. But the reality is that they may use their bully pulpit to nonetheless have an impact on how companies headquartered outside of the United States fashion their social or DEI programs. There are ways to make adjustments to your programs and how they're described, all the while remaining true to the inclusivity of what many, many companies see is key to recruiting talent into their pipeline. So DEI hushing, rainbow hushing, these terms are alive and well. And again, it's really important to get the Council of Lawyers in figuring out how to continue to press your objectives and priorities without getting unnecessary legal or political reputational risk. Why don't we go on to governance for a moment, and then I'll turn it over to my colleague, Jason Downs. Heretofore, there's been a great consensus around the importance of good governance in corporate America. And what governance really means is maximum transparency, checks and balances, independence of corporate boards. What we're starting to see, however, is that many companies are starting to flee states that had high governance principles, states like Delaware. They're fleeing as their headquarters to Delaware and moving to places like Texas, where the governance rules are more inviting to companies. So be on the lookout for trends that might include less transparency, less independence on the board, and greater pay packages to the C-suite as companies move away from stricter governance. That's my ESG piece, and I look forward to engaging with you. And now is my turn to pass that over to Rita Hunter.
Absolutely, because this has created, as Carl says, quite a lot of consternation, particularly for our UK European clients who wonder how they navigate these changes in the US. So, perhaps less for the small FinTechs, but as we know, a lot of FinTechs have grown quite considerably and do have business interests in the US and are concerned about the long arm of the US regulator and what's happening. And so we've built a team of people with Carl and Rita who really are here to help you navigate that regulatory uncertainty, which is a challenge at the moment. Over to you, Rita.
Thank you, Sharon. Hi, thank you so much, everybody. And thank you, Sharon. Yes, the regulatory uncertainty is definitely keeping us all very busy. And we're doing everything we can to help clients navigate all of this uncertainty. I was going to talk a little bit about the position in the UK, what we're seeing mainly in respect of ESG. But of course, it will be very difficult to have this talk without also talking a little bit about the position also in the EU. And apologies, I think I have frozen, but please shout if there are any issues with hearing me, but looks like you can still hear me. So in terms of the UK, look, I don't think we've really seen anything or the UK has done anything drastic to suggest that it's changing its approach on ESG as a result of the developments that Carl just spoke about in the US. I think, yes, there are some exceptions to that. As I said, maybe not drastic. There are some tweaks happening behind the scenes.
in respect of ESG regulation, perhaps being positioned as delays and pauses. But again, I'll sort of go on to that in a moment. But the reason why I say I don't think we've seen anything drastic is particularly when you compare it to, say, the EU, which has been for many years the leader in sustainability regulation, and has this year in February announced sort of a reshaping of its regulatory framework in respect of sustainability, and in particular disclosures and mandatory due diligence. And whilst there hasn't been any express confirmation that these proposals to change the scope of the European regulatory regime is because of what's happened in the US, we can always speculate that perhaps the timing suggests that there is sort of it was a bit of a response to the change in approach that we're seeing under the Trump administration. And certainly just the other week, there was a representative from the EU Commission who was speaking at a conference I attended. And yes, he said, whilst not on paper, yes, they had to respond somehow and perhaps look at limiting the scope of their regimes. Again, much more to be seen there because there's still a whole process to go through in terms of the European legislative process. But again, the UK hasn't really outwardly said that they're going to anything. We have been waiting for a number of years to see how the UK is going to finalise its regime in respect of sustainability disclosure standards, whether we're going to have a UK specific taxonomy regulation, what sort of transition plan requirements are going to be for companies and financial institutions. Now, I don't know. At the moment, I feel like we're in a little bit of a holding pattern. We're still waiting to see what's going to evolve or how things are going to evolve here. But I don't really have any inkling that our delays in the UK are a direct response or consequences to what's going on in the US. Having said that, in March of this year, the FCA did actually make an announcement on diversity and inclusion. And again, the timing would have, one speculate that perhaps this is a direct response to the sort of issues around DEI in the States. But certainly there was, in 2023, there was an FCA and PRA consultation in respect of proposed rules and expectations that were aimed at improving diversity and inclusion in regulated firms. And so a couple of years later, so in March of this year, an announcement was made that actually the FCA and the PRA have no plans to take the work further. So read what you want into that, but certainly that would be one of the changes that I think is worth mentioning, and it could be as a direct consequence, as I said, of what's happening in the US. Again, the reason cited was not because of the US, but there was things around avoiding additional burdens on firms at this time. So I think, in terms of the position, the UK does seem to be staying the course. However, I think, it's still looking at investment around clean energy, net zero policies, and we haven't really had any indication that it's going to roll back or do anything different in terms of that area and the initiatives that it's been setting up. And indeed, I think there was a recent announcement where the UK government said they need, £40 billion worth of investment every year to become sort of a leader in clean energy by 2030. But in terms of what we're hearing, say, with our clients, with other financial institutions, despite all of that, there has been, I think, a change in vocabulary, a change in language and terminology. So as Carl said, in particular on the DEI front, we've been looking at ESG reports that many of our clients have been producing where they operate all across the world, big presence, say, in the UK, big presence in the US. And that's the section that does actually warrant a lot of attention now, looking at the DEI, again, looking at targets and trying to find some kind of balance which enables UK companies to remain true to their ESG values and their ESG strategies, but without drawing unnecessary or unwanted attention to themselves and perhaps falling foul of any US requirements. So that has been an issue at the front of many of our clients' minds, and navigating the differences particularly when they also have, say, presence in Europe and they also have European regulation to comply with. So navigating those differences and enabling them to continue to satisfy their regulatory obligations on this side of the pond, and also not find themselves, as I said, sort of in any kind of unnecessary spotlight or trouble. On sort of just very quickly on asset managers, they, I think, are definitely finding it probably very, very difficult out amongst all of our clients in respect of how they navigate the different sentiments on ESG. And we've spoken to a few asset managers whereby they have a presence in the US or they have investments in the US. And just recently it was sort of, AGM season. And they were relying on DEI and climate as sort of being considered when making their shareholder decisions. And then you have some proxy firms which were essentially saying, actually, in the US, we cannot take any voting decisions now based on those two ESG related issues. And so that would put a lot of UK asset managers in a bit of a bind when, particularly as they've promised their investors that they are the types of issues that they consider and that they hold quite sort of important to their whole, to their overall sustainability strategy. So there have been a lot of issues that sort of have been arising, and it is really, quite a tricky time. And as Sharon said, a lot of regulatory uncertainty, which doesn't help the situation, but just trying to navigate and finding a balance to be struck between all of the different regimes is sort of, as I said, it's tricky, but it is doable. And, Carl and Jason and Sarah are very good at keeping us all, aware of what's going on and making sure that, as I said, the right terminology is being used. We're not doing anything here that essentially fetters our position in the US. And just very finally, in terms of other things that I'm hearing from clients, I think I mentioned it, but clients are really, they're wanting to remain true to their values. Some of the reasons cited for that is if they start changing ESG strategies, or if they start changing what their publicized ESG values are, obviously the DEI issue in mind, but they do worry that that will have unintended consequences going forward. So, their customers, their clients, their suppliers, stakeholders are all judging companies by what they stand for and what they say on ESG, and that's not going away despite what we're seeing at the political level. So yeah, interesting times. I will wrap it up and hand over to Jason now, and obviously welcome any questions at the end of this session.
Thank you, Rita. Thank you. Just before passing to Jason, I know, for having worked with Innovate Finance for years, that these topics are really very much at the heart of the membership also. And, I think it's difficult for us to come to terms with a lot of what we've just heard. And I think that in that context, listening to what's going on, supporting each other is really important, but actually also focusing on the opportunity. I think one can get oneself far too sort of engrossed on challenge, whereas I think there is a lot of opportunity for the fintech industry as we move really from the retail space into the wholesale space, where fintech can really drive, along with digital asset regulation and AI, phenomenal changes in our industry. And isn't it fantastic to be part of that? So with that, over to Jason.
Thanks so much. That's a great segue, because we're going to talk a bit about some opportunities in the digital asset space. And we'll start off by talking about the working group that President Trump established 3 days after taking office, which gives you a sense of how important the federal administration deems digital asset regulation. So 3 days after coming into office for the second time, the president established a working group on digital assets, and it has a few different components of the federal government participating in this working group. We've got the U.S. Treasury, the Department of Justice, the SEC, the CFTC, the chief of staff from the White House, and that's just to name a few. And the report from this working group, the full report, is due in July of this year, more specifically July 22nd of this year. And we expect to see information surrounding a proposed regulatory framework for digital assets and stablecoin markets, some recommendations surrounding national standards for consumer protection and market oversight, a full-throated recommendation to create a strategic Bitcoin reserve and a U.S. digital asset stockpile. And that recommendation came sort of in the interim. So on March the 6th of this year, there were interim recommendations that were provided, and that was one of them, more specifically to create this strategic Bitcoin reserve. At that point, back in March of this year, this gets to Sarah's point earlier, that there were several agencies that rolled back prior guidance. Of note here, the FDIC rescinded its prior notice for banks entering the crypto space to provide notice, which is a pretty big sea change in the regulatory environment here. The SEC, the Securities and Exchange Commission, signaled a sort of a willingness to move away from regulation by enforcement. And we'll talk about more specifics on that in a moment. And also of note for the March 2025 recommendations were that there were several industry groups that had input into those recommendations. SIFMA comes to mind. And so it wasn't just the federal government sort of putting together recommendations. There was industry participation as well. And it's not all talk from the federal government. We do have not only them sort of putting this working group and some recommendations, but we have concrete action showing that the federal government is moving to be a bit more friendly toward the cryptocurrency space or the digital asset space. Here are a couple of examples. In February, the federal government, more specifically the SEC, dismissed the Coinbase case, which was a pretty big deal. Note the states that had similar cases, not all of them followed suit. So it's not that the federal government and the state governments are always on the same page. In fact, they are not always on the same page. And there are some states that have maintained their Coinbase actions. Maryland comes to mind as one of those states. There are other really high-profile cases that were dismissed. Binance is another one. Kraken is another one that was dismissed in March. The Ripple case, the SEC dropped the suit after years of litigation. So I give you just those few examples to say it's not just that the government is talking about, the federal government is talking about being friendly toward cryptocurrency. They are taking action to show that the federal government is much more crypto friendly. And that has a few implications for the traditional financial institutions space, not least of which is we expect to see more financial institutions entering the crypto space. And thanks so much for going to the next slide. We expect to see the traditional financial institutions entering the custody markets or the asset management markets or the tokenization arguments. And just to quickly describe what I mean by those three terms, when I'm talking about crypto custody, it's exactly what it sounds like. It's a traditional financial institutions that are holding and protecting digital assets for individuals or institutions or for governments. The digital asset piece of the digital asset management piece is almost exactly what it sounds like, and that is financial institutions either investing or rebalancing portfolios surrounding digital assets. And then the tokenization is the term that is not exactly intuitive, but that is essentially a process of representing digital assets on the blockchain, which, as we all know, is the sort of publicly accessible public ledger of different transactions. So that's a way of representing ownership of a digital asset on the blockchain. So we expect to see more traditional financial institutions entering these three markets now that the FDIC and other agencies have rescinded their prior guidance. What that also means is, given the the stockpile that we expect to be created of forfeited digital assets, we suspect that traditional financial institutions and others will have more enhanced AML or KYC protocols surrounding forfeited or anonymous assets. We also expect financial institutions, including the fintech space, to coordinate more with the Department of Justice or the Treasury Department or the U.S. Marshals on digital asset traceability. So in other words, we're expecting to see a bit of movement in the financial institutions space because of the White House's actions towards crypto. But we'd be remiss if we didn't note that the federal government is just one piece of the puzzle. You also have to think about the states. Let's go to the next slide, please. The state governments are sort of all over the map, so to speak. There are some states that are deemed more pro cryptocurrency. I'm giving you a few examples. Wyoming, Texas, Florida. Texas and Florida have laws protecting Bitcoin mining. Arkansas and Missouri have, right to mine laws as well. There are some states that are deemed to be a bit more crypto cautious, if you will. New York comes to mind with its crypto mining moratorium, and California comes to mind as well. You also have to keep in mind that states have their own licensing and oversight regimes. And so although the federal government is more friendly, for example, if you're in New York has the DFS, the Department of Financial Services, which maintains a bit license regime that has strict compliance and capital requirements. Texas and California have also issued state-level crypto custody and licensing guidance. So we say all that to say, keep in mind that although the federal government is much more friendly, state governments have their own licensing and their own schemes and their own plans towards cryptocurrency. So it would be wise to determine which states in which you're thinking about doing business and looking specifically at those state-level regimes. And there's some state attorneys general that are deemed to be a bit more aggressive when it comes to enforcing actions surrounding cryptocurrency. New York is very aggressive. They have been for some time. Maryland is becoming increasingly aggressive. I mentioned earlier that the federal government dropped its case against Coinbase, but Maryland did not drop a parallel case. So that gives you a sense that although the federal government is much more welcoming, state governments need to be consulted as well. And so the main takeaway here is entering the crypto space is friendly, but you'd be wise to sort of balance state-specific laws with the evolving federal framework. And that's all I've got on crypto, and I'm happy to answer any questions.
Thank you, Jason. I can't see any questions in the box at the moment, but one thing I would say, after thanking my panelists for their presentation, was that I was incredibly energized by a trip to New York a couple of weeks ago. I'm sure that Matthew must be living this as well. But it was Digital Asset Week in New York, and the focus, the drive, the investment, the scaling, the really thinking about the use of stable coins, the tokenization of assets, were all big themes. And it was really interesting to see how the industry was coming together in a way that I have not seen it in the US previously. I think many were really stifled by an approach to regulation through enforcement. Many of my European and UK colleagues were also stifled by wondering what could happen if they did anything that touched the US. And I am actually quite excited about the opportunities in this industry for the time being. I still can't see any questions, perhaps open to Matthew to see if there's any that he has for our panelists.
Yeah, thank you very much. Thank you, Sharon. Thank you, everyone. I think our panelists gave us a lot of food for thought. So no Q&A yet that we see, but please feel free to add anything in the chat and we can certainly raise them. I think in the meantime, there are probably a few points where I'd be keen to follow up with my US hat. So we spoke a lot about the changing US landscape, and you mentioned, Sarah, some items around the stronger encouragements for bank and fintech partnership. Maybe going a little bit more broadly than that. Do you think there are new opportunities for fintech to engage in business in the US as compared to priors? And perhaps if you go a little bit across industries, what that might mean, please.
Sure. Thank you. Yeah, no, great question. So I think yes, because there are a lot of considerations, as you all well know, for fintechs either already operating here or looking to operate here. Both commercial and regulatory. I'll focus on the regulatory side, but I think, as I described earlier, do not mean to suggest anything, any regulatory requirements have gone away or that anything's easy, but there is a change in tone and reduction of certain barriers that make things easier. So the way I see it, if you're a non-bank fintech and you want to offer services in the US market, as compared to some other jurisdictions, we have the state-by-state regulation of things like payments, as Jason mentioned. Depending on your crypto-related activities, we have state level licensing for that, consumer lending and other types of lending. So effectively, what that means for a non-bank looking to provide financial services in the US is essentially two options. One is to evaluate, based on where you want to offer services, and if that's nationwide, that's 50 states plus DC, evaluate whether on a state-by-state basis you need a license of some sort, depending on your business model. And then, actually going and getting those licenses and maintaining them in compliance, as you can imagine, and as some of you may well know, is a very, big task. So with big tasks come big rewards, but that's what it takes here in the US to enter the market. The other option, and this is why I was really highlighting that bank fintech partnership model, is if structured correctly, and I'd like to underscore that with 5 underlines. If structured correctly, a bank fintech partnership model is another solution, and that is one that is attractive to fintechs for that reason, which is if the bank behind the scenes is actually providing the financial services. So if the fintech is not doing the payments, fintech attracts customers and performs other services, but not doing the payments, or the fintech is not doing the lending and it's the bank, that model can work. And I'm speaking in very broad strokes, needs to be structured correctly, needs to be evaluated carefully, but the fintech may not need then all the licenses state by state because it's not the party engaging in the regulated financial service, the bank is. So that's why I see, not to just focus on it from the bank side, but I see that as a really big opportunity, since that avenue, I wouldn't say it was closed off, but it was difficult over the last few years to find those kind of bank partnership models and have them succeed. And I think the current federal administration's focus on encouraging innovation actually will really help the non-banks and the fintechs because, absent going and getting the licenses in 50 states, let's say, that model can be another option. So I think, Carl and Jason, absolutely correct that we can't forget the states and all this. And but the fact that from the federal side, and that's, for the banks, this opens up a lot of opportunity for the fintechs. And then if structured correctly and everything in compliance with state law, it's a real viable option for US market entry that's typically quicker than the licensing process.
Yeah, and let me double down on that and just say that with the removal of the CFPB,
Yeah.
that is a major federal regulatory bureaucracy that many would say stifled, innovation and sought to enforce rather than support. With the CFPB's exit, what you're saying is exactly right. This is it's an open field that is presented to fintech companies.
Thank you, Carl, and perhaps I can keep with you. We've had a couple of questions in. The first from Marissa Ellis is really, I think, for you, and actually Rita. The question is, you mentioned an increased focus on financial inclusion. Given the pushback against DEI, what is the narrative that means that this is gaining support?
Well, Ms. Ellis, I saw your question, and it is a difficult question that you pose. So thank you very much for the question. Let me answer that in two ways. First, a lot of the anti-ESG movement, the group that also is not in favor of DEI, has also taken the position that there are certain groups that have been devalued by the banks, debanked by the banks. And they focused on political causes and conservative causes, as well as religious groups. And so even in the anti-DEI conversation, there is momentum around the term financial inclusion from groups that anti-DEI folks think were not being embraced by the financial institutions. And indeed, it's a real issue that financial players have to be aware of to ensure that they're making their products and services accessible to all. So that's one take on your question, Ms. Ellis. The other take on your question really goes to the point that while companies are very sensitive, and rightly so, around how they're portraying and memorializing and talking about their DEI commitments, they're also well aware that having access to talent, regardless of race, gender, etc., is incredibly important. And so they're looking for other ways that are not exclusive of groups, but are more broadly inclusive to ensure that they can continue to attract the best talent that they can. So that's the way in which those two principles are reconciled. Very good question, Ms. Ellis.
Thank you, and very well, ably answered, Carl. We're into the last few minutes, but an interesting question from Preston. I think that maybe this is either for Sarah or for Jason. How is Jamie Dimon's successor planning affecting fintech acquisition activity?
I don't know, Jason, do you want me to start with that? That is a good question. I guess short answer is time will tell. So I guess I'd think about this from a couple angles. One is we don't know, I think, timeline and specifics about successor, and then what that might mean, at least for that particular bank, JP Morgan's plans affecting fintech acquisition. I'd maybe zoom out a little bit and think about, all bank appetite for fintech acquisition, which I would expect is increasing generally for many of the reasons that we described today, and just keeping in mind that, of course, there are some banks that are larger and going to make larger acquisition than others. We have 5,000, roughly 5,000 banks in the US, 10,000 if you include credit unions. So there are lots of banks, including regional and community banks, that I know for certain are looking at fintech acquisitions. And so I think barriers to that, because that all needs to be approved by the federal bank regulators, we can expect to lessen, and that activity likely to increase in the next few years.
And when I was in New York 2 weeks ago, Apex announced its acquisition of Tokeny. I think that we're going to see increasing signs of scale over the next weeks, months, and years. And in that, obviously, there will be some winners and there'll be some losers. But that's what's great about having, such a good community of people who support each other, but at the same time also competing with each other. I think we're done with our questions. Matthew, can I hand it over back to you? But obviously our team are very happy to continue discussion with you again online or offline also. Thank you very much indeed.
Thank you, Sharon, and thanks to you, Sarah, Rita, Carl, and Jason, for sharing all your insights with us today. And thank you to all our attendees for joining us as well. On behalf of Innovate Finance, very pleased with this webinar. Please do feel free to visit our website, www.innovatefinance.com, to learn about the work we do for member companies and find out about our upcoming events. We're definitely looking forward to welcoming you again for future events. Thank you, everyone.
Many thanks. Bye-bye.
Bye-bye.
Bye.